Okay, let's unpack this. We're diving into some pretty significant regulatory news coming out of the U.S.
Yeah, the Securities and Exchange Commission, the SEC, has made a move. We've got sources detailing they've formally withdrawn several proposed rules.
Right, and these weren't just minor tweaks. They were proposed between, what, March 2022 and November 2023.
That's right. During Gary Gensler's time as chair, the announcement came just recently on a Thursday.
So what we want to do in this deep dive is get clear on exactly which proposals are off the table now. What would they have done? And crucially, for a lot of you listening, what does this mean for crypto?
Mm-hmm. The SEC did state, according to the articles, that they don't intend to finalize these specific proposals right now.
But they could propose something else down the line.
They could, yes. That option remains open. And while some sources link this to, broader political shifts.
Right, we're sticking to what the SEC actually did here, based on the material.
Precisely. Focusing on the rules themselves.
Okay, so let's get specific. Two rules really stand out in the source material. First, this proposed change to the definition of an exchange. Rule 3B16.
Yes, this one was about broadening what counts as an exchange under the Securities Exchange Act.
How so? What was the proposed language?
Well, it included defining an exchange to cover systems that offer the use of non-firm trading interest and communication protocols to bring together buyers and sellers of securities.
Okay, non-firm trading interest and communication protocols. That sounds deliberately broad.
It does, and the potential impact highlighted in the sources was significant, especially for crypto. Because that definition could have seen many decentralized finance, DeFi protocols categorized as securities exchanges.
Right. Applying traditional exchange rules to DeFi platforms, that's a huge shift. It's complicated.
Very complicated, and maybe that complexity is partly why it's been withdrawn. It was proposed back in March 2022, and the material notes that Mark Ieda, when he was acting commissioner, suggested dropping it earlier this year.
Interesting. Okay, what was the second major rule pulled back?
That was the proposed Safeguarding Advisory Client Assets rule, proposed more recently, March 2023.
And this targeted investment advisors?
Yes. It aimed to expand the existing custody rules under the Investment Advisors Act.
To cover what? More types of assets?
Pretty much all client assets, yeah. The goal was making digital assets more explicitly under SEC custody requirements.
How would it have done that? What was the core requirement?
The key thing was that investment firms would have needed to hold client assets, including crypto, with a qualified custodian.
And a qualified custodian usually means?
Typically, regulated banks or broker-dealers. That's the traditional definition.
Okay, and here's the rub for crypto, right?
Exactly. As the sources state, most crypto exchanges and wallet providers did not meet the definition of qualified custodians.
So the impact could have been advisors pulling out?
Potentially, yeah. The material suggests it could have forced advisors to find new custodians, which might be difficult or impossible for certain crypto assets, or maybe even just exit the space altogether.
And like the exchange rule, Ueda had apparently suggested reconsidering this one too.
Yes, back in March, the sources mentioned he asked staff to look at withdrawing it.
Were there other rules mentioned, just briefly?
There were things related to cybersecurity risk, reporting for large security-based swaps, and ESG reporting for public companies, so it wasn't just crypto.
But the crypto ones seem to be getting the most attention in the material.
They do, likely due to the potential disruption.
So let's boil this down. Why should you, listening, care about this? What's the so what?
Well, basically, these withdrawn rules represented specific, potentially quite heavy compliance burdens and structural changes.
Particularly for DeFi and for investment advisors dealing with crypto.
Right. Those pressures, as outlined in these specific proposals, are now off the table, at least in this form.
The industry noticed, clearly. The sources mentioned Paul Grewal from Coinbase.
Yeah, his post saying, down goes 3B16, qualified custodian, and all the other unfinished Gensler rule proposals. It captures that sense of, well, relief in some quarters.
So the immediate takeaway from the sources is those specific regulatory hurdles that were being built, they've been formally dismantled for now.
Exactly. These particular paths for regulating DeFi via the exchange definition and crypto custody for advisors are closed.
Which leaves us with a pretty big question, doesn't it? Something for you to think about. If these specific regulatory approaches are now off the books, what comes next for crypto regulation in the U.S.? How might things evolve from here?